When most people think of investments, they picture stocks, maybe a little crypto, or buying property. The usual suspects. But the wealthy play a different game. They buy things you've probably never even considered. Things you can't just scroll past on a brokerage app. And they're not picking them at random. Each one has a specific role, and together, they form a wealth strategy that works quietly in the background. If you jumped into the middle of this video, none of it would make sense, because each step builds on the last. So let's start at the ground level. Literally. Our first stop is farmland, the stable foundation that rich people use to anchor their entire investment portfolio. Farmland isn't flashy. You can't hang it on your wall, you can't post a screenshot of it on social media, and it's definitely not the kind of thing people brag about at parties. But behind the scenes, it's one of the most quietly powerful assets the wealthy own. The first reason is scarcity. You can print more money, you can build more houses, but you can't create more land. In fact, the amount of farmland in the world is shrinking because cities keep expanding into rural areas. And when something is both useful and limited, its value tends to rise over time. The second reason is demand. No matter what happens in the economy, whether the stock market is soaring or collapsing, people still need to eat. Farmland produces crops, livestock, and other essentials that never go out of style. This built-in demand makes it far more resilient to economic shocks compared to many other investments. For wealthy investors, farmland is also a steady income source. They don't have to become farmers themselves. Instead, they lease the land to experienced operators who handle the work, while they collect rent or a share of the profits. This turns the land into a predictable cash flow asset. Then there are the tax benefits. In many countries, owning agricultural land can qualify for reduced property taxes, special exemptions, or deductions that lower the investor's taxable income. These small advantages add up significantly when you're dealing with large-scale holdings. But perhaps the biggest advantage is its role in the bigger picture. Farmland is like the concrete foundation of a building, solid, stable, and able to hold up everything else you build on top. It doesn't spike in value overnight, but it also doesn't crash the way riskier investments can. And when the wealthy know their foundation is secure, they can afford to take bigger swings elsewhere. Which brings us to the next piece of the puzzle, an asset that shifts the focus from stability to higher returns: private credit. If farmland is the foundation, private credit is the engine that drives higher returns. It's a way for the wealthy to make their money work harder without relying on the public stock market. Private credit is essentially lending money directly to businesses or projects that can't or don't want to go through a bank. In exchange, investors get paid interest, often at rates much higher than what traditional bonds or savings accounts offer. These deals are usually short to medium term, anywhere from 1 to 5 years, and the interest payments provide steady cash flow. One of the big appeals for the wealthy is control. Instead of buying a stock and hoping the market goes up, they can set the terms of the loan, how long it lasts, what the interest rate is, and what collateral is backing it. This allows them to tailor the risk and reward to fit their broader strategy. Private credit also has a low correlation with the stock market. That means if the market drops, these loans don't necessarily lose value the same way stocks do. This makes them a useful tool for balancing out the volatility in a portfolio. Of course, there's risk. Businesses can fail, borrowers can default, and in some cases, loans can be tied up in long legal processes. That's one reason this space has traditionally been dominated by institutional investors and wealthy individuals who can afford to spread their risk across multiple deals. When combined with farmland, private credit plays a very specific role. The farmland provides stability and slow, steady growth. Private credit adds a layer of higher yield income that can be reinvested or used to fund other opportunities. Together, they create a blend of security and growth that's hard to replicate with traditional investments alone. And if you're learning something new here, now's a good time to hit the like button and subscribe. The next asset ties this whole strategy together, and it's probably the one that surprises people the most. If farmland is about stability and private credit is about income, then collectibles and cultural assets are about prestige, and sometimes explosive growth. We're talking fine art, rare watches, vintage wine, classic cars, even rare musical instruments. On the surface, these might look like indulgent purchases, but for the wealthy, they're often carefully chosen investments. One reason is that many collectibles hold or increase their value over time, especially if they're rare, historically significant, or tied to a famous name. A painting by a well-known artist or a first-edition book isn't just something nice to own. It's an asset that can appreciate quietly in the background, independent of the stock market. These assets can also act as a hedge against inflation. When the cost of living rises, tangible items that are rare and in demand often become more valuable. And unlike financial assets, they can be enjoyed while they appreciate. A bottle of wine displayed in a cellar, a watch worn at a networking event, or a painting hung in a home. For the wealthy, there's another advantage that's harder to measure: access. High-value collectibles often open doors to exclusive circles, auctions, and private events. These connections can lead to business deals, partnerships, and opportunities that more traditional investments can't provide. The strategy isn't about replacing farmland or private credit. It's about adding a final layer to the portfolio, one that brings in a different kind of value. Farmland provides the base, private credit delivers consistent income, and collectibles add prestige with the chance for big asymmetric gains. Together, they create a portfolio that's stable, profitable, and uniquely positioned to grow in almost any economic climate. And that's why the wealthy keep buying assets most people never even think about. Farmland, private credit, collectibles. Three very different assets, but together they form a strategy the wealthy rely on. Farmland is the rock. It's scarce, essential, and steady no matter what the markets do. Private credit is the fuel. It pumps out steady income that can be reinvested for growth. Collectibles are the wild card. They hold prestige, open doors, and can skyrocket in value. On their own, each is powerful. Together, they protect wealth, grow it, and create opportunities that most people never see. You don't need millions to think like the wealthy, but you do need to stop following the crowd. Focus on assets that bring stability, cash flow, and unique upside. That's how you start playing the same game.